Hey, it's Alex, and this is a Chapter 3 example, Problem 3-1A. Uh, I'm pretty sure it is. Yeah, 3-1A, adjusting entries. And this is just a little show of what would happen at the end of a period when you want to bring accounts up to balance. So for here, the first one is the supplies account balance on October 31st is $3,975. The supplies on hand on October 31st are $1,050. So here's a one where you had a beginning balance to start, but now you ended with a balance they gave you. And so what they want you to do is figure out what the difference is. What's the difference between this 3,975 and this 1,050 is going to be the journal entry. But the easiest way to do that is set up a little T account. See supplies, debits on the left, credits on the right. So you see we started with 3,975. We want it to end at 1,050. So we need to credit the account for 2,925. See, you can back into it using algebra once again to find that number. And then we come over here, and the journal entry, see it's October 31st, is you debit supplies expense for $1,050, and you credit supplies for $1,050. That shouldn't be 1,500. It should be 1,050. All right. But for the next one, okay, B, the unearned rent account balance on October 31st is $11,000, representing, come over here real quick, representing the receipt of an advance payment on October 1st of 4 months rent from tenants. So the tenants paid 4 months in advance on the 1st, but now it's the 31st. So legally, we can claim a month's worth of that rent. So here's our unearned rent, not rend. Sorry, I was using the, I'm trying out these new color markers, but I don't know if they work as well as I thought. But here, so unearned rent is normally a credit because it's a liability. Until we do the service or we provide whatever we need to provide within the time, it's unearned. But once a month's gone by, we've earned a month's worth of rent. So we take what we do is we take 11,000 divided by 4, and by doing that, we find each month's worth that we can claim. So on here, we can claim $2,750 worth of the 11,000, which will leave us with 8,250 in the unearned. But here's the entry. So unearned rent, we debit it for 2,750, and we credit rent revenue or rent income, earned rent, whatever the account you have, but for the same 2,750, because now we've earned it. It's gone from a liability to being earned. That entry is the same too. If you have a lawyer on retainer, the lawyer can't claim that money until they've provided the service. They've earned it. Okay, so here's C. Wages accrued but not paid at October 31st are 4,990 or 4,900. So here's the entry. Wages expense. Oh, sorry. Yeah, 4,990. We'll just leave it at that. But here's wages expense, and it should be, the debit would be 4,990, and the wages payable would be 4,990. Just forgot to put them in right there. But this one's a pretty simple one. So it's just basically the reason why you do that, the reason why you debit wages expense and credit wages payable is to show that you're not going to pay it this month, but you are going to pay it the next month. So that's an example of an accrual. So the unearned rent is an example of a deferment. You've deferred the revenue to a later period, but then you'll slowly turn that liability into revenue, where wages expense is an accruement where you're accruing the expense. Oops. You're accruing the expense, but you're going to pay it later. So you're recognizing the expense now, but you're going to pay it later. Okay, fees accrued but unbilled at October 31st are $4,900. So same amount, but different accounts. So we've earned, these are fees we've provided. So we've earned them. We just haven't gotten the money for them yet. So we debit accounts receivable for the $4,900, and we credit fees earned, or whatever your income count is. Fees earned for $4,900. And that is because we haven't gotten the money, but maybe we'll get it in the next month. Maybe we'll get it in November. Okay, and then E, depreciation of office equipment is $1,100. So if we come over here, we debit depreciation expense for $1,100, but then we credit accumulated depreciation for $1,100, and you can make sure it's office equipment, because accumulated depreciation, you might have multiple assets, fixed assets you're depreciating. So just make sure you label them right. So that's it. See, you debit depreciation to acknowledge you're expensing it, and then the accumulated is a placeholder, which will lower the book value of the asset on the financial statements. And the reason why you depreciate the whole reason you depreciate in the first place is because if you were to expense a large asset all at once, it would make your books, it would spike your books, especially for the month you expensed it in. So it's more conservative and it's more lucrative to depreciate a big asset over months and months and months, so that it doesn't overstate your expenses. So it's just smarter. It's all about keeping things smooth. You want your statements to be smooth. You want your income and all that to be smooth. So thank you. And on this one, the real amount was $2,500. So just pretend that was $2,500, and that's what would have been here on the wages. So these are the adjusted entries. An example, something you do at the end of the month. You do it just to catch up accounts, so that on the first of the next month, so we did the October 31st, so on November 1st, everything would be caught up, because everything would be in the right date, so that when we do our financial statements, they're not going to be overstated or understated because we forgot and left these out. See, supplies, if we didn't do this entry, our income would be overstated by $1,050. So it's good it's good to make your accounts up to date at month end. So thank you. If you have any questions, feel free to ask or leave any comments, any examples or whatnot. And I think I may go back to just a black marker and maybe use the color only for small details and whatnot. So thank you very much, and I'll see you for probably chapter 4 examples. Good night, good morning, or good afternoon.